Welcome to the Global Commerce Academy, your home for 100% free CMA USA classes. Whether you're just starting your journey in management accounting or you're preparing for the final stretch of your CMA USA exam, you're in the right place. Our mission is to make high-quality education accessible to everyone, everywhere, at no cost. Here, you'll find expert guidance, practical examples, and a supportive community to help you master every concept you need to succeed. Today, we've reached an important milestone, the final chapter in the section called External Financial Reporting Decisions. This section has been all about understanding how organizations communicate their financial performance to the outside world. We've covered the basics of financial statements, the principles that guide their preparation, and the standards that ensure consistency and transparency. Now, as we approach the end of this section, it's time to dive into some of the more advanced and nuanced topics that you'll encounter as a CMA professional. This is Chapter 8, Special Reporting Topics, from Part 1 of the CMA USA 2025 syllabus. In this chapter, we'll explore a range of reporting issues that don't always fit neatly into the traditional accounting categories. These topics are essential for anyone who wants to understand the full picture of financial reporting in today's complex business environment. From segment reporting and interim financial statements to foreign currency transactions and accounting for changing prices, these are the areas where real-world complexity meets accounting theory. Let's explore the critical topics that don't fit in traditional accounting boxes, but play a huge role in real-world reporting. These special reporting topics are not just academic concepts. They are the tools and techniques that organizations use to provide meaningful information to investors, regulators, and other stakeholders. By mastering these topics, you'll be better prepared to tackle the challenges of modern financial reporting and add real value to your organization. So get ready to expand your knowledge and take your skills to the next level as we begin our journey into special reporting topics. Topic 1. Interim financial reporting. Companies often publish quarterly financials. This is called interim reporting. It gives stakeholders a snapshot of performance between annual reports. Key points: use the same accounting principles as the annual report. Revenue and expenses should be properly allocated. Can involve estimates more than full-year reports. This helps investors track progress regularly. Topic 2. Segment reporting. Large companies operate in multiple segments, like business units or regions. Segment reporting shows how each segment performs. As per ASC 280 and IFRS 8, companies must report revenue, profit, and assets by segment and help users understand where profits or losses are coming from. This improves transparency for complex organizations. Topic 3. Discontinued operations. Sometimes companies shut down a product line or business unit. These are discontinued operations and must be reported separately. Why? It helps users isolate past performance from future projections. The gain or loss on disposal must be clearly disclosed. This is governed by ASC 205-20. Today, let's dive into a topic that might not come up every day, but is still crucial for anyone interested in understanding financial statements. Extraordinary items. These are the kinds of things that can really shake up a company's financial picture, even if they don't happen very often. So what exactly are extraordinary items and why should you care about them? Let's break it down. Even though the formal classification of extraordinary items has become less common in recent years, especially with changes in accounting standards, the concept still lingers in some reporting formats and in the way people talk about unusual events in business. You might still hear analysts or managers refer to something as extraordinary when discussing financial results, especially if it's an event that stands out from the normal course of business. So what kinds of events are we talking about? Extraordinary items are basically events that are both unusual in nature and infrequent in occurrence. Think of things like a major natural disaster, such as a hurricane, earthquake, or flood, that causes significant damage to a company's assets. Or maybe a sudden government expropriation of property, or a one-time legal settlement that's completely outside the company's normal operations. These aren't things you'd expect to see on the financial statements every year. In the past, accounting rules required companies to report these extraordinary items below the line, meaning they were separated from the company's regular operating results. This made it easier for investors to see what was truly unusual. However, under current standards like IFRS and GAAP, these items are now typically included within net income, making it even more important to pay attention to the details in the notes and disclosures. So, while the rules have changed, it's still really important to know how to properly classify and disclose these unusual events. Understanding extraordinary items helps you get a clearer picture of a company's true financial health and ensures transparency for everyone who relies on those financial statements. Always take a closer look at the notes and disclosures. They often tell the real story behind the numbers. Alright, let's dive deeper into a crucial topic. What actually happens after the balance sheet date, but before the financial statements are officially issued? This period, often overlooked, is actually packed with important activity. Imagine the company's year-end has just passed, say December 31st. The finance team is busy closing the books, but the world doesn't stop. Business continues, and sometimes significant events occur in the days or weeks after the balance sheet date, but before the financial statements are finalized and released to stakeholders. These events are known as subsequent events. They're important because they can have a real impact on how the company's financial position is understood. Think of them as developments that happen in the window between the end of the reporting period and the moment the financial statements are made public. Accountants and auditors pay close attention to this window because what happens here can change the story the numbers tell. Now, there are two main types of subsequent events you need to know about, and understanding the difference is key for anyone working in finance or accounting. The first type, called Type 1 events, are those that provide additional evidence about conditions that already existed at the balance sheet date. In other words, these events help clarify or confirm what was already true as of year-end, even if the details only became clear after the fact. For Type 1 events, the financial statements should be adjusted. For example, let's say a customer who owed the company money at year-end goes bankrupt in early January. If the bankruptcy was due to financial difficulties that existed before December 31st, this is a Type 1 event. The company should adjust its year-end receivables to reflect the fact that this money probably won't be collected. These adjustments ensure the financial statements are as accurate and complete as possible, reflecting all known information about the company's position at the balance sheet date. Type 2 events, on the other hand, are new events that arise after the balance sheet date, events that didn't exist at year-end, but are significant enough that users of the financial statements should know about them. For instance, if the company announces a major acquisition or suffers a natural disaster in January after the year-end, these are Type 2 events. They don't require adjustments to the numbers as of December 31st, but they do require disclosure in the notes to the financial statements. This way, readers are fully informed about significant developments that could affect their understanding of the company's future prospects. As a CMA or accounting professional, it's absolutely critical to recognize the correct cutoff period for these events. The window for subsequent events typically extends from the balance sheet date up to the date the financial statements are issued or available to be issued. Missing a key event or misclassifying it can lead to misstated financials or incomplete disclosures, which can have serious consequences for the company and its stakeholders. So, always stay vigilant. Review all relevant information and make sure you're capturing every event that matters in this important post-balance sheet period. Companies must disclose transactions with related parties, like owners, executives, or even family members. Why? Well, these deals might not be at arm's length and could, hide fraud or manipulation. Both GAAP and IFRS require clear disclosures to maintain trust and transparency. If a company may not survive the next 12 months, it's considered a going concern issue. The financial statements must include a warning disclosure and explain any plans to recover or shut down. This is super important for investors, and it's actually a core area of CMA ethical responsibility. A CMA must identify when a situation qualifies for special reporting, apply the right standards and judgment, and ensure timely as well as transparent disclosure. This is really where your technical skill meets real-world decision-making. From interim reports to discontinued operations, special reporting topics help tell the complete story behind the numbers. You've now completed Section A, External Financial Reporting Decisions of Part 1, CMA USA 2025. Stay with us at the Global Commerce Academy for free lectures covering the entire CMA USA syllabus.